The One Big Beautiful Bill Act, or OBBBA, is a landmark tax bill signed into law on July 4th that impacts every single American. While we don't know the exact implementation details of all of these provisions until later, here are 10 tenets of the OBBBA that may impact you. I'll bulletize the changes and make some kind of what does this mean commentary, and if you'd rather read it on the blog, you can. My name is Freeman Lindy. I'm a certified financial planner and enrolled agent with the IRS, which means I can give tax advice. And so let's break this down and what it means for you. Number 1, extension of the low tax brackets. This is a permanent extension of the 2017 Tax Cuts and Jobs Act provisions, locking in the current income tax brackets and deductions. So what does this mean? It means that there are no more automatic tax bracket increases for 2026 as the Tax Cuts and Jobs Act sunsets. This is fantastic news for anyone making over $55,000 as a household or $25,000 as an individual, as it locks in those lower tax brackets starting with the 12% tax rate. So it's fantastic news, no more looming tax tsunami. Item number 2, standard deduction increases. First, there's a standard deduction increase for 2025, about $750 per person, and that's in addition to the inflationary increases for this year that are already in effect, so yay, extra deductions. And then also there's a senior bonus deduction, which is an additional $6,000 for individual or $12,000 for married couples for those ages 65 and over through 2028. Right? And so that's a higher standard deduction for everyone, and an extra higher one for seniors means just less taxes, which is awesome. So we're happy about that. Item number 3, temporary increases in the SALT cap to $40,000 per household. For those who itemize deduction instead of taking the standard, the state and local tax deductions that can be deducted are capped right now at $10,000. This is going to raise that to $40,000. Right, so the base cap is raised, and that's just for tax years 2025 through 2029. Specifically, it's implemented as $40,000 in 2025, $40,000 in 2026, right, and then just increasing by 1% annually through 2029. So in 2025 then, in 2030 then, the cap reverts back to $10,000 for individuals and couples, and becomes permanent unless other legislation is passed. And what's more is it does phase out for people who make a really high amount, like over $500,000 for married filing jointly. So many individuals who take the standard deduction, because their itemized deductions are primarily the SALT deduction, mortgage interest, and charitable contributions. And with the SALT cap, as it currently is, many people get capped and they can't itemize. But with that higher SALT cap, more families can itemize and pay less taxes. So again, that's good news. Item number 4. Car loan interest deduction. So people can deduct up to $10,000 for interest on new U.S. assembled vehicle loans starting in 2025. So now this is only on new vehicle loans for purchases made between 2025 and 2028. There's no carryover, and it's not applicable to leases, right? So only new loans, only for that duration, then it just goes away. And you're eligible even if you claim standard deduction, right? It's not an itemized deduction, it's an above-the-line deduction. And it is phased out for individuals over $100,000 or married filing jointly over $250,000. And of course, I don't really recommend buying new cars, but if you're going to, this will add some relief. But keep in mind, right, because a lot of people are going to be running out to try to buy cars, keep in mind that tax deductions don't make up for wasted money. Right, a $60,000 vehicle at 5% interest will generate less than $3,000 in interest, and that new deduction will save you like $600 to $700 in taxes for the first year. That doesn't make up for the $1,100 monthly payment that you'd be paying on that in order to take advantage of this deduction. Right, so don't just run off and get a new car just because there's a deduction. Item number 5, child and dependent care enhancements. So the child tax credit is getting raised to $2,200 per child and now adjusted annually for inflation, which is awesome. It's been at $2,000 for a really long time. The dependent care FSA limit was raised to $7,500 from $5,000, so that's a big bump on that one, more than just inflation. The child and dependent care tax credit, which helps with daycare and whatnot, has now been expanded, and it's a little bit higher credit. So now couples with families with income between $43,000 and $206,000 who pay for childcare will see increased creditability on those expenses. There's also now an employer-provided care credit, which can incentivize businesses to subsidize care for their employees with direct tax relief. So more tax relief for families, especially with children and young children who need a lot of care from outside people that we hire. So it's good news. Item number 6, very along similar lines there, Trump accounts for children. Roth accounts are named after Roth, and I guess they wanted these to be named after Trump. So this is a tax-deferred savings account for children, allowing up to $5,000 in contributions from parents or others per year into the account. Employers may contribute up to $2,500 per account, and that's treated as non-taxable income, although it is included in that $5,000 max. And children born between 2025 and 2028 can receive a $1,000 seed money from the U.S. Treasury. Right? There's some additional funding options, restrictions around these accounts, but those are all pretty interesting. The accounts can be invested in low-cost index funds, right? Get those things invested, get them growing for your kids, and the accounts turn over to the child at age 18, and withdrawals are taxed at capital gains rates instead of ordinary income, which is really nice. And so, right, get the free money if you can. If you're having a child between 2025 and 28, there are likely some IRS clarifications with these accounts in the future, and implementing could take some time. But I do think this will likely replace UTMA accounts as the preferred general savings account for children. So if you got kids or grandkids and you want to save for just general savings, not education specific, this could be a really good option for that. Item number 7, no changes in Social Security taxation, right? There's previous versions of the bill that had direct reductions in the taxability of Social Security, but those are absent in the final bill, right? It's not there. There's been a lot of still kind of news out there that this reduced Social Security taxes, but it doesn't. That senior bonus deduction, which we already covered in item 2, helps people, retirees, and a lot of retirees 65 plus only live on Social Security or mostly live on Social Security. So it will effectively wipe out their taxes on Social Security, but that's just incidental, right? It's not a direct Social Security benefit. It's just a general income benefit, right? So there's still no increase in the phase-out numbers for taxability, all these things, no changes there. Item number 8, business and investment provisions. So the 1099 or the 199A QBI deduction is now permanently extended with some different AGI phase outs and phase ins added in there. There's a permanent restoration of 100% bonus depreciation, which I know all you non-business owners are really excited about. And the Section 179 deduction is raised from $1 million to $2.5 million. So again, all you non-business owners probably don't give a rip about any of that stuff. But I have some business owner clients. I'm a business owner, and so there's no big tax hikes coming. Not a lot of changes, negative, and so we won't really be paying less taxes than under Tax Cuts and Jobs Act, but we won't be paying more as it sunsets, which we were scheduled to do. So that's good news for business owners. Item number 9, estate and AMT tax adjustments. So the estate and gift tax exemptions are made permanent from the Tax Cuts and Jobs Act, right? So that excludes the first $15 million in estate value and estate taxes from estate taxes in 2026, and then inflates beyond that. And the alternative minimum tax exemption also increased to $1 million for married filing jointly. So the lesson there, right, is don't buy crappy insurance products to avoid estate taxes, right? That's a fear-mongering thing by a lot of people who sell products. Buy these crappy products to protect you from estate taxes. It's not an issue for almost everybody. And then item number 10, marketplace insurance premium tax credit enhancements are removed. This is a big one for a lot of people, right? So the increased premium tax credits will expire on December 31st of 2025. This repeals these enhancements that were made by the American Rescue Plan and the Inflation Reduction Act. And the other thing is that the repayment cap was removed. So if you underestimate your income and you have to pay some of that back, there used to be a cap on how much you had to repay back. That's all gone. You have to repay all of it. So many folks will pay significantly higher premiums for marketplace insurance starting in 2026, right? And this really impacts pre-65 retirees and pre-65 retirement planning, right? If you're retiring before 65, planning to be on marketplace insurance until 65 Medicare, there's a big impact for that, and big impact for small businesses that can't offer it. So that's really bad news, unfortunately, right? So what does all this mean? Every taxpayer faces different sets of realities based on income, age, family status, business ownership, and reliance on benefits, right? And so the OBBBA offers substantial tax savings for families and seniors, and they benefit immediately through these deductions and credits, which is awesome, right? It provides opportunities and complexity, right? Business owners and self-employed individuals may gain from expensing out options and new QBI rules and whatnot, but you got to plan for that accordingly. You don't just go in without a plan on how to optimize those. There's also a lot of long-term uncertainty, right? The deficits, the energy costs, the Medicaid cuts, a lot of this could raise taxes or reduce services down the road. And so that's just something to keep an eye on, right? That this chicken might come back to roost. And so because the OBBBA is so sweeping and so intricate, and effective tax and financial planning are more crucial now than ever, right? So just some next steps for you, right? As a certified financial planner and IRS enrolled agent, right, uniquely qualified to give comprehensive financial and retirement advice and tax advice. And so I help translate these benefits and changes into your real world plan. Whether that means maximizing senior deductions, leveraging business tax breaks, revising retirement distributions, or optimizing education funding strategies for your kids or grandkids, we are here to help you navigate what does this mean for you directly. If you're already a client of mine, thank you. And the OBBA effects on you and your personal plan will be covered in depth in our fall review here in fall of 2025. If you're not yet a client and you'd like to understand how the One Big Beautiful Bill affects your unique financial situation, we do offer complimentary discovery meetings. They're totally free, and we can help you understand kind of how that affects you. So welcome to schedule that with me. Link in the description. Totally free. So let's ensure that your investments, your taxes, retirement, and legacy benefit from these changes and not get blindsided by them. We'll see you around soon. Stay the course, and cheers.